Right now, somewhere in Augusta, Georgia, there are homeowners who rent out their own house for exactly 14 days a year, collect thousands of dollars for it, and legally pay the IRS not one single cent on that income. Not a reduced rate, not a clever deduction. Zero. And here's what should genuinely bother you about that story. It's not a secret. It's not some backroom deal for the ultra-connected. It's written directly into the federal tax code, has been since the 1970s, and the overwhelming majority of Americans have simply never been told it exists. That's the real story behind almost every single legal way wealthy and financially savvy people lower their tax bill. It was never really about hiding money. It's about knowing which doors in the tax code the government left wide open on purpose, doors most people walk straight past every single year without ever realizing they were even there. Here's a number worth sitting with for a second. The federal tax code, along with all of its accompanying regulations, runs to well over 70,000 pages. Nobody is expected to read all of that. Not even most tax professionals genuinely know every single provision buried inside it. But that enormous length isn't accidental complexity for its own sake. A huge portion of it exists specifically because Congress, over decades, kept carving out targeted incentives for very specific behaviors it wanted to encourage: buying a home, starting a business, saving for retirement, employing family members, investing for the long term. The people who consistently pay less in tax aren't necessarily earning more. They're simply the ones who eventually stumbled onto or deliberately learned which specific pages actually apply to their own life. So today I'm walking you through 7 of those exact doors, real, completely legal strategies written directly into the tax code, several of them available to regular working Americans, not just business owners or the ultra-wealthy. Every single one of these comes from actual tax law, not some gray area workaround. And I'll tell you clearly which ones apply broadly and which ones need specific circumstances to actually work. Stick around because strategy number 1 is the exact one that Augusta homeowner story is based on. And by the end of this video, you'll understand exactly how it works and whether it could apply to your own situation. Let's get into it. Strategy number 1 is the Augusta Rule, officially Section 280A of the tax code, and it's genuinely one of the cleanest, most straightforward provisions in the entire system. Here's how it actually works. If you own a home and you also own a legitimate business structured as an S corporation, a C corporation, a partnership, or a multi-member LLC, you're allowed to rent your own personal residence to that business for up to 14 days a year at a genuine fair market rental rate for legitimate business purposes like board meetings, planning retreats, or strategy sessions. Your business deducts that rent as a normal business expense. You, personally, don't report the income at all, and you owe 0 federal tax on it. This rule exists because Congress specifically carved it out decades ago for homeowners in Augusta, Georgia, who rented their homes out during Masters Golf Tournament week and argued it was unfair to treat them like full-time rental businesses over one single week a year. Business owners eventually realized this exact same provision applies to them too. The catch, and it's a hard one, cross into a 15th day of rental in that same calendar year, and the entire exclusion disappears, making every single dollar of rent for the whole year fully taxable, not just the days beyond the 14th. Documentation matters enormously here too. A real rental agreement, a fair market rate genuinely comparable to what similar local venues would charge, meeting agendas, and attendee records, because the IRS has specifically pushed back on inflated, poorly documented versions of this strategy in tax court. A well-run version of this strategy generally involves getting a few written rate quotes from comparable local venues, hotel conference rooms, or private event spaces, and setting your own rental rate at or below that documented market range. So if the IRS ever does ask questions, you have a clear paper trail showing the rate was genuinely reasonable rather than inflated for tax purposes. Strategy number 2 is the 0% long-term capital gains bracket, and this is genuinely one of the most underused strategies available to completely ordinary investors, not just the wealthy. Here's what most people don't realize. Long-term capital gains, meaning profit from investments held more than a year, aren't taxed at the same rate as your regular paycheck. For 2026, if your total taxable income falls below roughly $49,000 as a single filer or roughly $99,000 filing jointly, your long-term capital gains are taxed at exactly 0%, not a lower rate. 0. This matters enormously for anyone with a lower income year, someone between jobs, a retiree in their early retirement years before other income kicks in, or even a student with some modest investment gains, because it opens the door to a specific technique called tax gain harvesting, deliberately selling appreciated investments while you're sitting in that 0% bracket, paying no tax at all on the profit, and then immediately buying the exact same investment right back. That resets your cost basis higher, meaning less of your future growth will be taxable whenever you eventually do sell for real. And unlike the wash sale rule that applies to selling investments at a loss, there's no waiting period required here at all. You can genuinely repurchase the same investment immediately. It's worth understanding why this particular bracket goes so consistently overlooked, and it comes down to a fairly simple communication gap. Most people only ever hear about capital gains tax in the context of paying it, articles and headlines about investors owing large sums when they sell a winning stock. Almost nobody talks publicly about the flip side, that a meaningful chunk of the population, anyone with taxable income under those specific thresholds, can sell long-held appreciated investments and genuinely owe nothing at all. If your income fluctuates year to year, self-employment, a career transition, a partial retirement, deliberately checking whether you're sitting inside that 0% window before you sell anything significant is a genuinely simple habit that costs nothing and can save real money. Strategy number 3 is the health savings account, and it's worth repeating specifically because so few people actually understand just how uniquely powerful this account is compared to literally anything else available in the tax code. If you have a high deductible health plan, contributions to an HSA reduce your taxable income going in, the money grows completely tax-free while invested, and withdrawals for qualified medical expenses come out tax-free too at any point in your life, even decades later. No other account offers all 3 of those tax advantages stacked together simultaneously. The genuinely smart move a lot of financially savvy people use here is paying current medical expenses out of pocket with regular cash, keeping every single receipt, and letting the HSA balance itself grow completely untouched and invested for years or even decades. Then, whenever you actually need the money, you can reimburse yourself for all those old expenses, pulling out a large sum completely tax-free, even though the money's had years to compound and grow in the meantime. There's genuinely no expiration date on this either. The IRS doesn't require you to reimburse yourself in the same year the expense occurred, which means a stack of properly saved medical receipts from a decade ago can still be used to justify a tax-free withdrawal today, effectively turning an HSA into one of the most flexible long-term tax shelters available to anyone with access to a qualifying health plan. Strategy number 4 is hiring your own children if you run a business, and this is a genuinely legitimate strategy the IRS actively permits, provided the work and the pay are both real. If you own a sole proprietorship or a properly structured family partnership, you can pay your child a genuine wage for actual work they perform for the business, filing paperwork, social media management, basic administrative tasks, age-appropriate work that fits their actual skill level. Here's why this matters so much. Your child can earn up to the standard deduction amount, over $14,000 in 2026, completely income tax-free, since it simply falls below the threshold where federal income tax even applies. And for a sole proprietorship or a partnership owned entirely by the child's parents specifically, wages paid to a child under 18 are also exempt from Social Security and Medicare payroll taxes, and exempt from federal unemployment tax if the child is under 21. That income you'd have otherwise paid yourself and been taxed on at your own higher rate instead goes to your child, essentially tax-free, and can even be used to fund a custodial Roth IRA in their name, giving them decades of tax-free growth before they've even graduated high school. The word genuine is doing a lot of work in that explanation, and it's worth being direct about why. The IRS specifically looks for real evidence that the work actually happened, actual hours logged, tasks that genuinely match the wage being paid, and a rate comparable to what you'd pay any other person doing that same job. Paying your 8-year-old a substantial hourly wage for vaguely defined chores is exactly the kind of setup that invites scrutiny, while paying your 16-year-old a reasonable wage for real, documented social media or administrative work is a considerably more defensible, legitimate use of this same provision. Strategy number 5 is the home sale exclusion under Section 121, and this is genuinely one of the biggest, most broadly available tax breaks in the entire tax code, and most homeowners barely think about it until the exact moment they're actually selling. If you've owned and lived in your primary residence for at least 2 of the last 5 years before selling, you can exclude up to $250,000 of the profit from capital gains tax entirely if you're single, or up to $500,000 if you're married filing jointly. For the overwhelming majority of home sellers in this country, that completely eliminates any capital gains tax owed on the sale of their primary home. The mistake some sellers make is not tracking the improvements they've made to their home over the years, because those improvements, a new roof, a renovated kitchen, an added addition, increase your cost basis, which can matter enormously if your home's appreciation happens to exceed that exclusion threshold, particularly in a market where home values have climbed significantly. Keeping a simple running file of receipts for major home improvements over the years, even just photos of invoices saved in a folder on your phone, is a genuinely low-effort habit that can meaningfully protect you if your specific home ever appreciates enough to bump up against that $250,000 or $500,000 threshold, since a higher documented cost basis directly reduces the taxable profit the exclusion needs to cover. Strategy number 6 is the 1031 exchange, specifically for real estate investors, and it's one of the most powerful wealth-building tools available in the entire tax code, letting you defer capital gains tax indefinitely when you sell an investment property, as long as you reinvest the proceeds into another qualifying investment property within specific IRS timelines. Here's the part that genuinely surprises people the first time they learn it. You can keep doing this, selling one investment property and rolling the proceeds into another repeatedly for your entire life, deferring the tax bill every single time. And if you hold that final property until you pass away, your heirs inherit it at what's called a stepped-up basis, meaning the property's value resets to its current market value for tax purposes, and all of that deferred capital gains tax that had been building up for years or even decades simply disappears entirely. This is precisely why real estate remains one of the most tax-efficient ways to build long-term generational wealth in the entire country. The strict timelines involved here are genuinely worth knowing before you ever attempt this strategy, because missing them entirely disqualifies the exchange. From the date you sell your original property, you generally have 45 days to formally identify potential replacement properties and 180 days total to actually close on the new purchase. These deadlines are firm, with essentially no flexibility for extensions, which is exactly why real estate investors using this strategy typically work with a qualified intermediary specifically experienced in managing 1031 exchanges, someone whose entire job is making sure every procedural requirement is met correctly and on time, since a single missed deadline or improperly structured transaction can turn what should have been a fully tax-deferred exchange into an immediately taxable sale. Strategy number 7 is qualified small business stock, sometimes called Section 1202 stock. And while it applies to a narrower group of people, specifically startup founders and early employees, it's genuinely one of the most powerful exclusions written anywhere in the tax code and worth knowing about if you're anywhere near that specific world. If you hold stock in a qualifying small C corporation for more than 5 years, you may be able to exclude up to 100% of your capital gains from that stock sale from federal tax entirely, up to specific dollar limits based on your original investment. For an early employee or founder at a company that eventually has a significant successful exit, this single provision can represent a genuinely enormous amount of completely legal tax savings. And it's a provision Congress specifically built to encourage investment in small, growing American businesses. This is exactly the kind of provision worth knowing about, even if you're not currently a founder yourself, because it can meaningfully shape a genuine career decision. An early-stage job offer that includes equity in a qualifying small C corporation carries a tax advantage baked directly into its structure that a comparable cash-heavy offer at a larger, more established company simply doesn't, which is worth factoring into that decision alongside salary, benefits, and everything else typically weighed when comparing two job offers against each other. Here's the principle running underneath every single one of these 7 strategies, and it's genuinely worth understanding clearly. None of this is about hiding income, using offshore accounts, or exploiting some kind of loophole that technically shouldn't exist. Every single one of these provisions was deliberately written into the tax code by Congress, specifically to encourage certain behaviors: home ownership, small business growth, family employment, long-term investing, retirement savings. The tax code isn't simply a list of rules designed to extract the maximum possible amount from every taxpayer. It's also a genuine roadmap of incentives, and the people who consistently pay less in taxes completely legally are very often simply the ones who took the time to actually read that roadmap rather than assuming it wasn't meant for them. It's worth remembering, too, that these strategies aren't mutually exclusive, and the people who benefit most from the tax code typically aren't using just one of these in isolation. They're layering several together, contributing to an HSA, while also holding investments long enough to potentially catch that 0% bracket, or running a small business that both hires family members and qualifies for the Augusta rule in the same tax year. Each individual strategy might save a modest amount on its own, but stacked together deliberately year after year, they genuinely compound into a meaningfully different financial trajectory over the course of a working lifetime. I want to be honest with you about something important before we wrap up. Several of these strategies, specifically the Augusta rule, hiring your children, and qualified small business stock, require you to already have a business structured the right way, and getting that structure wrong or documenting it poorly can turn a legitimate strategy into a genuine audit risk. This isn't a video telling you to attempt any of this completely on your own with no guidance. A conversation with a qualified CPA, particularly one who specializes in small business or investment tax planning, is genuinely worth the cost here, because the money saved by correctly implementing even one of these strategies very often dwarfs what you'd pay for that professional guidance many times over. If this changed how you're thinking about your own tax situation, drop a comment telling me which of these 7 strategies applies most directly to you. I read every single one. And if you want the deeper breakdown specifically on how to structure a small business, the right way to actually qualify for strategies like these, subscribe, because that's exactly what we're covering next. The tax code rewards people who understand it, not people who avoid looking at it, and now you know exactly where a handful of those doors actually are, and which ones might genuinely be worth walking through yourself. I'll see you in the next one.